My name is Paul Ginsberg, and I'm really pleased to welcome you to this conference, which we called Stabilizing the ACA's Insurance Market. And in Washington, we tend to think of the ACA as a national program, but individual and small group insurance varies a great deal by local market and by states, particularly by states because of the important role that state regulators play. And we know that the ACA is playing out differently in different parts of the country. So to really understand how the ACA is playing out, you need to go out to selected states and localities and not only look at their data, but importantly to talk to the people there. Such field research is the essence of the project that's the focus of this conference, led by Mark Hall, and funded the project, the research by the Robert Wood Johnson Foundation, and this event by the USC-Brookings Schaeffer Initiative for Health Policy. In addition to extensive national document research, this project tapped into the ACA Implementation Research Network at the Rockefeller Institute of Government to interview leaders involved in the individual and small group insurance markets in 10 carefully suggested states. And I want to give particular mention to Richard Nathan, who created and leads the research network and that played an important role in this project. He could not be here in person, but is watching on the webcast. Finally, before I introduce our lead speaker, Mark Hall, I want to mention that we've been busy running meetings, and we have two of them next week. On Wednesday, we're having a conversation with Scott Gottlieb, FDA Commissioner, about biosimilars, and have an outstanding panel of 3 experts to react to his remarks. That's going to be on Wednesday afternoon, 1:30. Also, at the end of the week, we have a conference on the experience with MIPS. I can't remember what MIPS stands for, but those that are interested know it very well. And the experience with MIPS to date, and the policy options to address its shortcomings. So without further ado, let me introduce Mark Hall.
Great, thanks. What makes my slides project? Oh, there they are. Should practice ahead of time. Anyway, thank you very much. It's been a quite interesting project, and I really appreciate the support that we've gotten from the Brookings Institution, as well as Robert Wood Johnson, and then advisors at Academy Health who administer the program that was funded under, and also thanks to Dick Nathan, who again was a real leader in generating the structure that allowed me to do this work. So the gist is that as you look over the sort of the arc of now 5 years or so of open enrollment, that things got off to a bad start with the web problems, but once the web problems were dealt with, there was a good amount of competition in most states, existing carriers, new carriers, and prices were remarkably low in the view of many people, and as it turns out, they were underpriced, but the market was pretty vibrant for the most part. But then troubles really started to emerge in 2016 as carriers realized they had overpriced or weren't competitive, withdrew big price hikes. And then leading into 2017, the question was that going to continue? And there's a sense that perhaps the market was reaching sort of a new equilibrium with fewer carriers and higher prices, but one that could sustain itself. But then we began to sense that destabilizing forces were still at play, not just financial, but now sort of more policy shifts under the Trump administration. So this sense of destabilization, first arising from the fundamental market dynamics and then moving into the policy shift arena, gave impetus for this study to see what's happening in a variety of states with regard to market stability, efforts to maintain or improve stability, or effects of destabilizing influences. And just to remind us what those policy shifts are, not to give this undue influence, but just sort of this is the latest round of challenges to the market. Ending the payments for cost sharing reductions was a big blow to the market in the sense that that's a large amount of funding stream that was built into, assumed by carriers' pricing that was suddenly going to go away with unknown effects. Repealing the individual mandate, which is up until now been seen as fundamental to the structure of the ACA, and therefore how could the market function without that. And then the introduction of greater availability of non-compliant ACA plans, the idea that you would have sort of regulated and unregulated markets unfold side by side. Short-term plans is what we focused on, but you can also talk about association health plans or sharing ministries or farm bureaus, those sorts of things. So those are sort of the three major developments that emerged over the past year, but other important changes. There were a variety of sort of more I don't want to say minor changes, but secondary changes that shortened the open enrollment period and made it more difficult to enroll through special enrollment by increasing the verification requirements. Mixed views on positive and negative about that. Reduced spending for outreach, and just this week greatly reduced spending for navigators. Association health plans, as I mentioned, and then a set of measures that were introduced early in the Trump administration labeled as stabilization measures that provided more flexibility to carriers in terms of how they set the standardized plans or how they're assessed for their medical loss ratios. So it's a lot of detail, regulatory detail, but just kind of as a first sweep, a lot went on over the past year, and the question is how did all that play into the underlying sort of market dynamics that had emerged the year before. So I remind us of the metaphor of the three-legged stool, and this is Charles gave us, handiwork here in terms of, and don't take in the details, but the idea is, you start with the three-legged structure, which is the regulatory requirements are complemented by the subsidies to purchase, which are necessary in order to comply with the mandate. So as you sort of chop away at one piece, the stool gets to be, wobblier, and maybe it'll still stand, but not, quite as sturdy. We don't quite know, and so we could go through the whole list. But each of the things I mentioned, is and somehow meddling with. This was actually with regard to the ACA replacement bill. So a lot of these aren't actually in current, but you can visualize your own version of that, and so that gives rise to what do we mean by stabilize, as I introduced the topic, and stabilize is in the eye of the beholder. So even if the market had reached a stable point in 2017, 2018, 2010, it's a much different market than what we started out with. Stable might mean less competition, or stable might mean a sort of a plateau of very high prices. So we defined it this way, but we allowed informants to sort of use the term the way they wanted to. Insurers remaining in the market, covering all the market is important to stability. Prices are always going to increase, but hopefully won't increase a great deal more than general medical cost inflation. One metric for that would be are prices increasing more than they are for other kinds of insurance, for group health insurance, and hopefully they're avoiding steep or sustained declines in enrollment. So extreme forms of this you would call death spiral. Death spiral is a frequently used term. Even if death spiral has not happened, is the market getting weaker in ways that reflect these dimensions? So, and then all these points are up for discussion and question, but I'm just sort of laying out the premise in terms of our conceptual map. And here are the 10 states that we chose, a nice variety of locations and also structures and demographics and such. Here's a quick rundown. We had a mix of state exchanges and federal exchanges, states with and without Medicaid expansion, and states that were higher or lower priced. I won't go through all the details, but there they are, and they're in the report. I should say, in terms of the report, I think a summary has been distributed, and a full copy is online, just released today. And for those who want an autographed copy, I'll be signing at the back on the way out. I think we have a small set of the full version in hard copy on request. Starting with enrollment. So as you probably all know, folks in this room are pretty well up to speed. We were pleasantly surprised by the absence of any big dip in enrollment, given all the uncertainty about the future of the ACA, all the sort of controversy over its repeal and replacement, cutting open enrollment in half, cutting outreach funding, by however amount. Many people expected a big drop-off, but not only did we not see a drop-off, we actually saw an increase. So these are the latest figures just released last week of what's called effectuated enrollment. So like all these data, you got to pay a lot of attention to where they come from and how they differ from different sources. So a few months ago, we were looking at initial signups, and those had dipped a bit. But when you get to the actual people who pay their first month's checks, or who have not yet been kicked off for failure to pay their checks, and I'm not quite sure how they measure effectuated. Somebody in the room can tell me. But using that as a measure, your insurance is actually taking effect. We actually saw almost a 5% increase this year over last year as of the end of February or beginning of February. Anyway, February something. Don't hold me to the details. And you can see in our study states, does this give me a pointer? It does. Can you see this pointer? No. I can see it here. Well, anyway, if I move, is that bad for it is. All right. If I had shadow puppets, I could see. Quite a range. So some states had big increases. Some states held level. No states had a big drop. And we'll hear more about why that is. And then on the right-hand column is how things went the year before. So you can see that Minnesota had a big increase, and we have Lynn Blewett here to tell us a bit why. And Arizona had a big drop last year, but an increase this year, and so I'm here to tell you a bit more about that. But right now, we're just looking at the national pattern. And so this relative success and sort of continuing enrollment, it was attributed to a number of things. Number one, the publicity itself about the ACA was thought to bring in people. The idea that it might be in jeopardy, so if you need it and want it, you better get signed up. It was actually a motivator. The amount of free press, what's the phrase, earned media, meaning you work for it, you don't have to pay for it. I think that's the concept. You all probably know the phrase. Shot way up. A media firm measured a 125% increase in publicity about the ACA around open enrollment. And so that helped bring people in, but also just sort of the fundamental resilience. The word resilient was used over and over again. Of the subsidy structure, the idea that most enrollees through the exchange are subsidized. Over half of them are highly subsidized by the various metrics, and as prices go up, their subsidies go up, and so it's just a good deal. And if you have limited open enrollment, people know they better get signed up, and that structure seems to be working quite well to keep the basic boat afloat. But that was only with respect to the subsidized portion. So for the unsubsidized portion, things are quite different. As prices go up, they have to pay the full cost. And so over and over again, I heard that when I say I said I'm channeling my field researchers who took detailed notes and wrote it up. So it means we. Over and over heard that the market did surprisingly well for the subsidized portion, but for the unsubsidized, it's really in trouble. Enrollment is dropping off quickly, and this is where you're more likely to hear impending death spiral and things like that. Technically, it wouldn't be a death spiral because the what's the phrase? Single risk pool means the prices are the same across subsidized and unsubsidized, but those prices become increasingly unaffordable for the subsidized, giving rise to this metaphor of subsidy cliff. And so the idea is that the subsidies cap the cost of insurance at roughly 10% of household income up to 400% of poverty, which is roughly $100,000 a year for a family of four, $50,000 a year for a single. So if you started out in 2014, 2015, and insurance cost roughly, say, $5,000 for a single and, say, $10,000 for a family, being at this border of subsidized, unsubsidized wouldn't make much difference. 10% of your income is roughly what insurance would cost without the subsidy. So you might get a little bit of benefit for being just below the subsidy level, but you wouldn't lose very much if you're just above. But insurance prices have basically doubled, more or less, since the beginning, or since year 2 or whatever. And so now if insurance costs $10,000 for a single or $20,000 for a family, you suddenly lose a $5,000 or $10,000 subsidy by earning $100 more than the subsidy level, which is, extraordinarily uneconomic, as you know, but it was just a structure that was put in place initially. I'm sure everybody thought things would be revisited and revised, but it's a structure, given those percentages, that no longer works well if given the prices we have in the market. So that means that if you're above the subsidy cliff, or not just if you're above, but if you're at risk of being above, because if you think, okay, great, I'm safely at 380% of poverty, so I'm capped at 10%, but gosh, when you do your tax return for the next year, you ended up at 410%, you suddenly owe a $20,000, subsidy refund bill. I'm not quite sure how all that works, but it's theoretically possible. It really means that if you're anywhere sort of close to that borderline, you're going to think very, very carefully about that full sticker cost, and that's where the sticker shop is happening. And so we heard that over and over again. And so you see, again, just released within a week, I think, the drop-off in unsubsidized enrollment. Now, here we're looking only at ACA plans, so the problem is the lamppost only shines on the ACA market. There's also the non-ACA market, they'll show you. But even for the ACA plans, not counting the grandfathered, grandmothered, non-compliant, we see a 20% national drop-off in 1 year. And in some states, we see a 30, 40, 50, even 70% drop-off in a single year. Okay, now we are in death spiral territory if you've got a 70% drop-off, but coupled with if you've got 50 or 60% rate increases. And so this is the area of great concern. Here you see the same point. The top line shows subsidized enrollment holding steady over the last couple of years, but the bottom line shows it dropping off suddenly starting in 2017, which is when the big rate increases really started to go in. And this is Charles Gaba again trying to extrapolate onto that a rough estimate of the non-ACA plans that would be the top bar and making the drop-off even sharper. That said, you have this split between subsidized and unsubsidized. You also have a less prominent but still distinct split between state-based and federal exchanges. And so for the last few years, through various measures, the states that run their own exchanges have done somewhat better than those that rely on the federal exchange. This shows that point with regard to enrollment increase and also with regard to loss of subsidized, non-subsidized enrollment. So on the right column in particular, the loss of unsubsidized enrollment in 2017 was twice as large in the federal exchange states than in the state exchange states. And that is potentially due to a number of reasons that we heard from the field interviews. First of all, state-based exchanges invest more in making the market work. They have the structure, they have the money on their own to pay for the outreach and marketing and navigation. There's also sort of the social political climate. So these exchanges tend to be in the more of the blue states that embrace the principle of the Affordable Care Act, and state-based federal exchanges tend to be the more hostile states. And so that plays out, I think, in terms of the basic social political dynamic, as well as a set of regulatory provisions. So the state-based exchanges were more likely to not allow the transitional plans or the non-ACA plans to continue, and the federal exchange states were like, we'll do whatever you want. So those things, I think, build up over time, and you can see that. Now, they're not dramatically different, but there's differences there to note. All right, so moving on to insurer participation. I have a lot of ground to cover, and I realize I've already, used over half my time, so I'm going to start talking, moving faster. I'm already talking fast. So we have seen drop-offs of insurers, but the big point is that the major drop-off was the year before, and the drop-off in 2018 was about half as much. Various versions of that story in various of our states, but over half the states had very little drop-off for 2018. The only one with a big drop-off was Iowa, and we'll hear more about that. But the gist is that, that insurers enter, insurers leave, and we had a big retrenchment around 2016 into 2017. That retrenchment continued to some extent into 2018, but we're hearing now that it seems to have leveled off. We're not hearing any concern about bare counties or big withdrawals, at least as of, say, 2 weeks ago before the latest news dropped. Among reasons that insurers left was ability to sustain profitability. But here's a conceptual chart. These aren't representing actual numbers, but you can think in terms of market-wide averages versus fluctuation for particular insurers. And what we saw in various themes, and I'll elaborate more in my separate talk, is that maybe on the whole, enrollment has held steady or increased, or maybe prices in general have been on a steady and then steep climb and then leveling off. That would be the orangish line. But for a particular insurer, they can experience quite a bit of cyclical volatility, and that is due to the fact that the change in the reference plan for the subsidy can differ each year, as well as in the first couple of years there's a lot of shakeout in terms of the market moving from the traditional PPO plans to more narrow network HMO plans. And then as that happened, insurers would find that they would suddenly get a big influx of enrollment they didn't expect, or they would lose a bunch. And it was hard then for actuaries to really peg the numbers they need. This was the kind of volatility that things like the risk corridors were intended to buffer. But of course, when those weren't funded, that made the amplitude of these changes even greater. And so some version of that we heard in a variety of different ways, which I think caused a number of the insurers to pull out and say, we don't know if we can get a sustainable, profitable price that's competitive or not, or we've tried it and we couldn't. And so you have the market sort of settling in on a smaller set of insurers, but they seem very committed to the market because, again, there's this bolus of subsidized enrollees that will come back year after year, plus the state regulators have let them get the rate increases that they need to maintain profitability. So if you got 8, 9, whatever million subsidized people, and you can price at a level that's profitable, those price increases just go back to increase the subsidy. Why not stay in the market if you're in a position to sort of have the competitive price? And that's the gist. And so actually going into 2019 in initial rate filings, we've seen market reentries. So the Blue Cross plans that had previously pulled back in Iowa, Maine, and Ohio are either entering or suggesting that perhaps they might reenter. Oscar and Bright Health, which are two startup insurers, look like they're going to be moving into additional states. Even Alaska, you've got the potential of reentry by a previous market entrant. So in some states, we see a story where the market sort of settled in on a single carrier structure, maybe not just one carrier for the whole state, but one carrier for most of the rural areas and maybe one or two in the urban areas. And that seemed to be a more stable structure for a while, and is a reason that states were able to cover the potentially bare counties is that you offer up to insurers, there are some subscribers, charge what you need to, money, to be made. And so the prospects of bare counties don't seem very likely. But the question is there going to be multiple insurers in most of the states and most of the markets? And one of the issues is this market structure really conducive to a large number of insurers competing side by side, and I think views are still kind of open on that. So looking at price increases, can you get your prices? This is a lot of data, but let me stress the gold premiums because that kind of reflects what's happening in the unsubsidized part of the market. They tend to go for the gold package, and that's the price that isn't influenced by the subsidy structure keyed to the silver premium. And so you see the gold premiums going up less than the silver premiums for reasons that you're already aware of. You also see a difference in state versus federal exchanges again, but you see a wide variety across the different states. And again, this is too much to absorb in one sweep, but you see actually premium reductions in Alaska and Arizona for particular reasons, but then pretty significant increases in Colorado, Florida, and the rest. We'll go to the specific stories later, but the point is 2 years in a row of mid 20% increases. This is not sustainable, and the question is what happens in the future. But one result of these increases is that insurers have become profitable and perhaps handsomely profitable. So this is released by the White House Council of Economic Advisors recently. And it shows that insurers in the individual market are now more profitable as of 2017 than they were prior to the ACA. That is, they are earning a larger margin than they were before, and they're earning it for a lot more people. So to the point that there's money to be made, and so having achieved that, the assumption is then premiums could then begin to level off at the rate of general medical inflation, as long as things don't get rocky again. So it's capable for this market to achieve a delicate balance between, the right type of competition and the right type of pricing. But obviously, the point of this is, as somebody said, the market's still on thin ice. It wouldn't take much to disrupt it. And so the question is, are there disruptive signs ahead? And of course, we now know that there were. It actually was the sense from a number of our informants as of, I think we wrapped up these interviews back in May or so, that, yeah, I think we're hitting a stable place. So, I think it's okay to come back into this market, or I think next year is going to be much better. But since then, the Department of Justice said that if that Texas suit is successful, we're not going to enforce the guarantee issue and community rating rules. Or in last month, CMS said, well, we're not sure these risk adjustment payments are done right, so we're going to just suspend $10 billion of payments. We'll get back to you on that later. And then, of course, this week's news on Navigator funding. And who knows what's next. So part of the problem is the experience insurers had last year is they just don't know what shoe is going to drop next. And this adds to not only their reluctance to enter the market, but also their pricing decisions. They have to price for what they know as well as what they don't know, and sort of the known unknowns, and to go back to that, or the unknowns and all that. What is an actuary to do, really? I mean, it's hard enough in terms of the cycling of your enrollees and your risk pool, but then you throw into this an unstable set of market rules. And not just not knowing what the rule is, but the time it's going to take to know the rule's effect. And so the point is that you have to file your rates roughly 6 months in advance of the next full year. And so you won't get the data from the change for at least another year. And sometimes that data is not in until you can do the following year's increases. And so that makes it hard enough, again, for normal actuarial science, but you throw into that, we'll call it political science or something, it really makes it quite difficult. So case in point, ending the cost-sharing reduction payments, of course, this was a market disruption where the story had a somewhat happier ending, because most states figured that they could load that increase onto the silver plans only. That happened in the great majority of states, and it resulted in this phenomenon people have heard about, which is that this actually increases the subsidy, because the silver plan determines the subsidy. So you start out, and I won't take the time to go through these numbers, but basically a phenomenon where because the silver plan subsidy goes up, you can get a gold plan cheaper than last year, and perhaps cheaper now than even the silver plan. And your bronze plan, which last year maybe cost $100, now maybe perhaps is free, because if you dig down the details, your subsidy went from $500 to $650, an increase greater than the actual increase in prices. So as a result, you can see the effect of the silver loading back at this chart that you saw before, where the overall average premium went up in the mid-20s, but the silver premium went up in the low 30s, and therefore the actual gold premiums, the unsubsidized premiums, if you will, went up more closer to 20% on average. And you see that pattern in most of the states except for Colorado, which didn't have the silver loading, or Alaska and Arizona, which actually had rate decreases due to their reinsurance programs. So if you look at the other 7 states, you see this pattern of the gold increase being significantly less than the silver increase. So ultimately then, many of the subsidized people are better off because they got free bronze plans, or they could buy gold at the same price. Unsubsidized were largely unaffected. They just had to go through the hoops of maybe moving off from on the exchange to off the exchange. There's further complications that Louise can tell us about, because if their income changes in the middle of the year, then they're kind of trapped off exchange, and it's more complicated than reflecting, but essentially they had options that reflected what they had previously. But the federal government ends up spending $30 billion more, roughly speaking, because, again, subsidy amounts went up. And so at the end, there was all that, and insurers were comforted to hear that the silver loading would be allowed for this year. And in fact, when it was proposed in Congress that we reinstore the desperately needed cost-sharing reduction funds that everybody decried the loss of, public interest groups said, whoa, no, we don't want that money back. It's actually working better now without that money. And so the story was very, interesting. Mandate repeal, I'm going to pick up even more speed. It's less destabilizing than everyone thought it would be, mainly because folks are signing up due to the subsidies, and the mandate wasn't that strong to begin with. Everybody already thought that enforcement was going to be weaker than it had been, and there were a number of exceptions and things. So at the end of the day, the kind of estimates that come from the CBO that perhaps it will add 5 to 10% to premiums seem about right. Now, that might end up driving a million or few out of the market, which is significant, because if those people come uninsured, that's a big bump up in the uninsured. And if you spread those premium effects, and I'm focusing just on the individual market, but if they also affect the mandate affects enrollment in Medicaid and in group plans, then you can end up with several million fewer uninsured people. It's just that those people weren't part of my study. So that's not to say that the mandate wasn't important. And a number of people thought that the mandate could be helpful, and if there's any flaw with the mandate, it was too weak, and we could have used a stronger mandate. So there is some interest in, and Commonwealth just released a report, I think yesterday, sort of summarizing all this and using various assumptions about behavioral responses. So you can get a wide range of estimates. So that there's some interest in having a replacement for the mandate, but none of our states were pursuing that. A few others are. So what about reinsurance? You've heard a lot about that recently. Can it come in and fix the market? As you know, the ACA had reinsurance for 3 years. The start was rockier enough that more than three was reasonably needed. In Medicare, reinsurance is a permanent feature, but it's a much more stable market than the ACA, so there's certainly good reason to have reinsurance not only for a longer transitional time, but for having a permanent feature as it is in Medicare. And this could help deal with that ongoing actuarial uncertainty caused by the annual fluctuations in which plan is the best deal each year, and in the areas where there's less actuarial data. And so encourage insurers to enter or remain in more of the rural areas. And particularly attractive is you can use a Section 1332 waiver to sort of get supplemental funding called pass-through payments, whereby if the state-funded reinsurance reduces the federal subsidy hit, then the feds will free up that money to add to the reinsurance pool. So you get a small sort of multiplier effect by state investments in this. But there were problems. First of all, if you model it at the amounts that realistically being proposed, you're only looking at a 10 to 20% rollback in otherwise increases. And that would be just a one-time effect. So that's enough to sort of counter 1 year's kind of rate shock, but what about the other years? And therefore, it was seen, people kept on saying either stopgap or Band-Aid or something we desperately need something, and this could help, but a sense that it wouldn't be sort of the final fix. Also, there was a fair amount of frustration with the federal review process that was sort of encouraged and then bogged down, and a lot of technical reasons and back and forth, and here maybe some of that from the Minnesota example. The realization that to get your 1332 waiver, the state really needs to invest in the program, and of course states that are hostile to the ACA are reluctant to do that, even those that support it. Finding substantial new sources of funding is not an easy task. And ultimately, I love this phrase, the insurers are reminded of, and policymakers, that they lost the risk corridor funding, they lost the CSR funding, who knows what else is going to come through next. The 1332 waiver process wasn't as easy as was promised, and so, if we put all this investment into it, is the federal government just going to yank the football once again? And this was actually heard in Maine. I think they've sort of calmed down a bit, but there was some sense in Maine that's seeking a 1332 waiver. Did they actually want to implement it? Because as they look around, is the federal government really going to follow through with the promised funds? I mean, that was a serious concern that was expressed, and so I love the phrase to kind of capture that concern. Another issue was, okay, if we're going to invest in stabilizing the market, is reinsurance the best way to do it? It lowers the price market-wide, but most of those are subsidized, so its effect on the unsubsidized is somewhat diluted or indirect. What if we took the same money and actually reduced the prices for the unsubsidized through some type of rebate or extended subsidy fashion. And so that idea was suggested but not developed. So let me sort of get to my final topic and sort of borrow 5 minutes, and I'll give it back on my other presentation. We have these non-compliant plans that I mentioned. They're popping up in various ways. We did hear a fair amount of concern about destabilizing effects through market segmentation based on adverse selection. If only the healthy people can get these, it's going to pull them out of the regulated market, raising prices even more. And you add to that the repeal of the individual mandate penalty. So before, you'd have to pay the penalty if you pursued a non-compliant option. Now you don't have to pay the penalty, so that makes it even more attractive to explore. But other states thought, or other informants, there's mixed views in all the states, but some more than others, thought this might be worth trying. So for instance, folks at that subsidy cliff really don't have any affordable options, so at least this gives them something. To the extent the prices do increase in the regulated market, you've got the premium subsidies to shelter most of that. The problem, though, is, and simulation models actually show that because things like short-term plans are considerably less expensive because they're less protective, still the number of people signing up will actually go up by 1 million or so, and the estimates are all over the board, but they don't show an overall decrease in the number of insured. They show an increase, and the rate increases for the ACA market might be rather moderate, all things considered. So this does leave as sort of the final thought. There's, I think, a real fork in the road, or the potential for a split market, that some states where the market's done fairly well might still want to try to keep it all together and discourage these non-ACA plans. And that might be more likely for the state-based exchanges. For the markets where things are already in deep trouble and not likely to get better, this might be the least worst sort of path forward, least worth considering. But the question is, what about the unsubsidized uninsurables? For them, they're left worst off. And so there's this bright idea that I read somewhere, maybe somebody in the room came up with it. What if we tax the non-compliant plans to help subsidize those who otherwise wouldn't qualify? So the unsubsidized portion of the ACA market is really becoming a high-risk pool. So, high-risk pools need a subsidy. So if you think about it that way, maybe some type of sort of way of dealing with the free rider issues of, split markets, some Solomonic splitting of the market baby could be the best path forward for some states. So there's more to flesh out there, but I think it introduces kind of a final theme of uncertain path forward. I won't dwell on this slide because my time's up, but the bottom line is, gosh, it sure would be nice if we could take the politics out of this and just sort of work together to see if we can make these markets better. So I invite the panelists up forward to see if that optimism might prevail in any states they're from, and then open things up for audience discussion. So thank you.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.